A very good morning, friends. So I hope you're all doing well. And as usual, I keep asking that question on the, I would say, assumption that you've made your cumulative revisions for the previous 3 lectures on financial instruments. But just to remind you, our focus is on Ind AS 32 as of now, and we've learned a couple of things on Ind AS 32. Our last session was focusing on the concept of compound financial instrument. And as always, I've had my constructive obligation to give you a mind map at the very start of the previous learnings. I am going to do that today as well. So what I'm going to first of all remind you the insights, what we have developed on the concept of compound financial instruments, and then we're going to take journey forward because we are discussing still the compound financial instruments, some special issues, that is the treatment of a transaction cost in reference to CFI. And we also need to talk today in terms of early redemption of a compound financial instrument. But before that, I think let's just connect the dots. If you made the revisions, I think you'll perfectly fine-tune the concepts in your mind. So I'm just going to make a little quick mind map on the learnings on compound financial instruments, which we developed in the previous class. Now, the first thing what comes to the mind is when you look at the compound financial instruments, I would say you should revise your things divided in terms of 3 parts. So I would say when you're looking at a compound financial instruments, you can pen down your thoughts in terms of a CFI in terms of 3 agendas. So as I also said in the previous session, we're discussing the agenda number 1. Then I would say what should come to the mind is agenda number 2. And then what should come to the mind is the agenda number 3. That's how you can, actually in your mind create a mind map that yes, this is how we need to actually, make revisions on the CFI. Now, the first agenda is how to identify it's a CFI. So our first agenda was focusing on the fact how to identify that financial instrument is a compound financial instrument. And I think for this particular purpose, I gave you a total of 3 inputs. I said one is that you could look at an instrument which has got one component FL and one component equity, though it's non-derivative in nature. So I think in this particular case, we decided typically, I would say 3 categories. So in this particular case, we decided a total of 3 categories of instruments, which could turn out to be a compound financial instrument. So we discussed that one component of the instrument is supposed to be a financial liability, and one component of the instrument is supposed to be equity instrument. That makes it a compound financial instrument. And we also said that this is typically a case where it is a non-derivative instrument. It is typically a case where it is a non-derivative instrument in this case. We also did one illustration in the study mat where we identified that one of the components was equity, one of the components was FL, and therefore it became a CFI. You can maybe map the illustrations later on that. Then we talked of another instrument which is a perpetual debt. And there were certain special considerations which we discussed on the agenda of a perpetual debt. And we said that every time a perpetual debt may not be a CFI, you cannot say that if it is irredeemable in nature, simply because it is irredeemable, it becomes an equity component. So we learned something special at this particular stage. And we said the perpetual debt, you need to compare the coupon rate versus, you can say, the market rate. If this is equal, then it is supposed to be a financial liability. But if the coupon rate is less, then it becomes a compound financial instruments. So we did our extensive level of discussions on this area, and I gave you a comparative position that when it is a perpetual debt, be careful. see that the market rate of interest compared to the coupon rate, it is equal or not. Because if it is equal, then there is no equity element, and if it is less, then it becomes a CFI. We saw that illustration in the study material as well. And then I took you, and even this is a case of, you can say, a non-derivative. And then we came to a little special agenda, and that was the case of, you can say, optionally. That was a case of optionally, you can say, convertible financial instrument. Now, this is where we decided, that invariably, you can say in this particular case, it is always a CFI. Reason we said earlier, the coupon rate of interest on a convertible instrument will always be less as compared to a coupon rate on a non-convertible rate. So in this particular case, we said, we drew reasons why it is a CFI. So you can see the reason why it is a CFI, because one component is FL and the other is equity. The reason why it is a CFI, because you can say the coupon rate is less as compared to the market rate. So the reasoning behind the fact that it becomes a CFI needs to be very crystal clear at the back of your minds. And in this particular case, we said that the coupon rate in this particular case is always less as compared to the coupon rate on non-convertible instrument. So when you look at the coupon rate on a convertible instrument, the company would be paying less as compared to the coupon rate on a non-convertible, and that would mean that it is supposed to be a case of CFI. But also we discussed in this particular case, just to remind you, that the moment you say it is optionally convertible, it also means there is a derivative. There is a derivative, and you need to apply the fix for a fixed test to decide whether we need to segregate the derivative or not. If you satisfy the fix for fixed test, the equity element is not segregated. In that particular case, we'll land up in the second issue, we'll land up segregating. That I'll document in the second agenda. That in that case, we segregate only the FL and the equity element. But in terms of, you can say that it is not satisfying the fix for fixed test, it becomes a derivative financial liability. Then you'll end up segregating the three elements, though we have not seen any illustration on that part. Where we would have seen that, there is a case of a derivative element, but you can say 2 or 3 elements gets segregated depending upon the derivative meets the equity characteristics, or you can say a financial liability. So this was the agenda number 1, which we discussed on the CFI. Then we were talking in terms of the agenda number 2. So in my mind map, then we were discussing the agenda number 2. And our agenda number 2 was basically discussing the concept of a split accounting. We were discussing the concept of a split accounting, and I gave you the inputs. How do you calculate the financial liability? Which particular discounting rate is chosen? And in this case, we did a variety of instruments. So in this particular case, when you look at the variety of compound financial instruments, I made a walkthrough in terms of a couple of them. So I started my journey in terms of a perpetual debt. So we started a journey in terms of a perpetual debt instrument. Then we went ahead and looked at the case of optionally. Then we looked at the case of optionally convertible instrument. Then we look at the case of a partially convertible instrument. And then we also started looking at, which we are still solving, and that was compulsory convertible, mandatorily convertible in nature. So that was compulsory convertible. So when you do the split accounting, your mind needs to be very crystal clear that, when you're looking at a split accounting, how does the perpetual debt, optionally convertible, partially convertible, and a compulsory convertible take place? What is the element which is included in the financial liability component? And I think I'll just like to take a quick recap and make an interesting mind map on that part as well. That when you're calculating the element, of the split accounting, what comes in the financial liability and what comes in the equity element as well. So just to remind you, when we were looking at the concept of a perpetual debt, in this particular case, we had only, you can say, continuous streams of interest. There was nothing else. So in this particular case, what we did, we considered the present value of only the interest element. We consider the present value of only the interest element in this case. There is no principal repayment, so only the interest was discounted at a particular rate, which is, of course, the market rate which is given in the question. In this case, when you take the present value, there is no benchmark rate in terms of instrument which, the interest rate which prevails on a non-convertible instrument. In case of perpetual debt, we'll just be given a market rate of interest, which you need to consider. And then the balancing figure enters the equity. We'll very shortly talk in terms of where does this equity element go. We will see that. That's also, I'm going to put that in the mind map as well. The second is when you consider the optionally convertible. Here, the assumption is that it is convertible at the option of the holder. We have not discussed in terms of the option of the issuer in this case. We've taken a presumption that when I say optionally convertible, it is optionally convertible in the hands of the holder. So in any case, the issuer has got an unavoidable obligation to pay both the interest as well as the principal element. So in this particular case, you'll end up considering the present value of both the interest. We'll end up taking the present value of both the interest and the principal. Because as an issuer, you've got an unavoidable obligation to pay. And if you've got an unavoidable obligation to pay, you need to consider the interest and the principal both. So I think just to connect the dots, let me also tell you that in this case, when you take the present value, you consider the market rate, which is commensurate to the risk profile of the issuer. And when you consider the present value in this case, it is supposed to be what I called the benchmark rate. This is what I called as the benchmark rate. So, you need to be very crystal clear. Because before the exams, these kind of mind maps is going to be very, very helpful. Please make your add-ons to this mind map after you've done your questions and all. Just make those value additions. What more points need to be kept in mind? So when you consider the present value, we consider the benchmark rate, and this benchmark rate is the rate on non-convertible instrument. So this is supposed to be the benchmark rate which prevails on a non-convertible instrument, and we consider that. Similarly, we also saw the concept of a partially convertible instrument as well. And in terms of partially convertible instruments, we took the present value of interest and only the portion which is paid in cash, the principal portion which is going to be paid in cash. And principal, so this is both the interest and principal, which is going to be paid in cash, not the component which is going to be paid in terms of shares. So this is what we're going to consider in this case. And trust me, when you consider the present value, the same concept of the benchmark rate applies here as well. Now, compulsory convertible, we're yet to see, but I think we just connected the dots in the previous session as well. Then when it is compulsory convertible, your obligation to deliver cash is only restricted to the interest element. So in this particular case, when you consider the compulsorily convertible, so we take the present value of only the interest in this case. The principal element is paid in the form of shares, so that's not considered. So what element enters the financial liability calculation? That needs to be very, very clear in your mind. Do we take the interest and the principal both? Do we take the principal only, the portion which is paid in cash? All that elements need to be clear. And even in this particular case, when you consider the present value, this is again the concept of a benchmark rate itself. Now I'm just penning down all the thoughts consecutively, one by one at a single place. And then comes the element as far as equity is concerned. Of course, the equity becomes a balancing figure in all these cases. The equity becomes a balancing figure in all these cases. But what we need to now consider that what happens to this equity at the end. I want to understand also that what happens to this equity. Now, all these equities you've seen enters the tab number 3. And that is, it enters the SOKI, the tab number 3. So as far as this equity is concerned, so we can say as far as this equity is concerned, it rests in statement of changes in equity, and that goes in the tab number 3. But what happens to that particular case? Let's also take a quick recap. In terms of a perpetual debt, it remains there. In terms of optionally convertible, it goes to the capital reserve or it goes to the share premium as the case may be. And in these two cases, it will be divided between the equity share capital and the share premium. Wow. So in this particular case, we can say it continues. It continues in the tab. And in this particular case, it is either transferred to share premium or capital reserve. In this case, it is split between the equity share capital and the share premium. And in this case, also equity share capital and share premium. So this is the treatment. This is the treatment which is at a later date. Then what happens to this equity at a later date? I think this chart is supposed to be the most comprehensive, and it connects all the dots points, which gives you a clarity in terms of different kind of instruments, what particular discounting rate is used, what are the elements of financial liabilities you consider, what is the element of equity, how it is tackled. I know I didn't ask you questions on that because I wanted to make some revisions with you. So I just connected all the dots in a single chart. Hope this helps. Okay, so this is done. That was the agenda number 2. So this was the agenda number 1. Then this is the agenda number 2, which we discussed in the next slide. I made the summary, and we're still working on the agenda number 3. So today we're going to discuss the agenda number 3. That's what we're working on. Right, friends. So I think all the dots are connected. I have given you the insights in terms of how you're going to look at compound financial instruments. And trust me, questions come extensively in the exams on compound financial instruments. And if you're clear in terms of what is to be done at which stage, I would say like jingalala. Right, friends? I hope that helps. You're connected with the dots on this, correct? Okay, so that's wonderful. I think I have got... So initially, it will be tab number 1 now. We need tab 2. Oh, I think I made a mistake. That's right. Thanks for the correction. I said it goes in tab 3. My error. It goes in tab number 2. You're right. So this goes to tab 2 eventually. Right now, it goes in tab 1. My error. I just, took this as OCI. Thanks for the correction. That's absolutely correct. Okay, so I think this is done. Tab 3 is OCI. That was rightly pointed. So I hope, friends, the revision mind maps working good in your mind. You could connect all the dots in terms of what we have discussed, correct? I think I've just made summary of all the inputs which I gave you as just a single go in terms of these 2-page summary. Okay, so that helps. That's wonderful indeed. Great. Now we are going to go to the next agenda. And we were talking about this particular question. I will just zoom this question once again. And this is a third case where we're going to talk in terms of the agenda number 3 as well. So let's have a look at the question number 3. Let's see the question number 3. Once again, we were discussing the agenda number 3 with you. And let me remind you what was the agenda number 3. I am focusing on the treatment of TC, transaction cost, in terms of CFI. I've got 2 special agendas in the agenda number 3. The special issue number 1 is the treatment of TC in a CFI. And the second issue is the early redemption of CFI. Let's, I think, first work on the treatment of TC. Along with this, we're also working on a compulsory convertible instrument. So there are two things going simultaneously, working on a CCD or a CCPS, and we're also working on the treatment of TC simultaneously. It says a company issued a compulsory cumulative convertible preference shares, triple CPS, on 1st April X1 at the rate of 150. The dividend rate is 10% every year, and the preference shares are convertible into 5,000 equity shares at the end of the 5th year from the date of allotment. When CCPS are issued, the prevailing market rate for similar debt without conversion is 15%. And we are given the transaction cost is 2% TC. The allotment date is given and the date of conversion, a gap of 5 years. The number of preference shares, the face value, this is the proceeds, and the TC is supposed to be 2% of this. 2% would mean 30,000. The dividend rate is 10 and the market rate for similar instrument is 15, non-convertible. Transaction cost already given 30, and the face value of the equity shares is 10 and the number of shares is 5. Necessary entry for the entire term of the arrangement from issue till conversion. From issue till conversion. Now, let's come back on the calculations we made in the previous class. Now, hear this carefully, because I've intentionally taken a question which has got a little more technicality. A similar kind of this question is there also where the technicality gets diluted, but I wanted to explain the technical part. Now, let's watch this. So I am working, let me just put my heading, I am working simultaneously on my agenda number 3. And in this case, I'm working on a special issue. I'm working on a special issue, which is the treatment of TC. I'm working on the treatment of TC for CFI, that is for a compound financial instruments. If you're looking at the treatment of a TC, that's what we're looking at. Okay. Now, I told you one thing very clear, that when you are looking at a presence of a TC, don't get worried. Don't get worried about the TC at the start. Forget about the TC. You just do the split accounting the usual manner. Don't even bother about the TC at the initial start. So what we're going to do, we're going to first of all do the split accounting, which we, I think, already did. And I consider the proceeds, and I'm sure you have the data already with you. So I guess the proceeds are to the extent of 15 lakhs. And we can split this between the two elements, that is FL as well as equity as a balancing figure. So just to recreate and put a question to you, since I've not put any questions since morning. So are you going to consider the interest and the principal, or just the interest element to calculate the financial liability? It is a compulsorily convertible instrument. So are you going to consider the interest and the principal, or just the interest? And that's right. So we're going to consider the interest on 15 lakhs at the rate of 10%. And if you remember the cumulative factor, that is PVIFA at the rate of 15% for a period of 5 years, if you remember what we took in the last class. So what was the present value interest factor annuity? At the rate of 15%, 1 divided by 1.15, 1, 2, 3, 4, 5. I think it was 3.3522. This was 3.3522. I think that's what we did in the previous class as well. I think, yes, I would have got that answer because we did that working in the previous class as well. And I think I didn't get any answer so far. Yes, that's right now. So let's take this 1,50,000 into 3.3522. It comes to 502,830. That is the financial liability. So the equity becomes a balancing figure. So that works out at 997,170. That is the balancing figure. I've taken 4 decimal places in this case, and that's the figure which we get. Okay, so this is 15 lakhs minus 502,830. That's 997. That is correct. Okay, so this is done. Now with this particular inputs in hand, now we come to the concept of TC. So I also gave you in the previous session itself that when you look at the TC, the transaction cost is given to me. It's 2% of the proceeds that is already given in the question. That's 30,000. Now this 30,000 is the TC to organize the liability as well as the equity, and the treatment of the TC for both the elements are different. And since the treatment of both the elements are different, there is a need to segregate this TC, how much relates to equity and how much relates to FL. So what are you going to do? Divide this in the ratio of FL and equity. So this amount is going to be divided in this ratio. So we have the FL and the equity. So we will divide this, that this is to be divided in the ratio 502,830 is to 997, 170. So divide it in this particular ratio. So once you divide this in this particular ratio, we'll get the split. That's 10057, 10057. That's right. And that was 19,994. Superb. So this is the split of the transaction cost between FL and the equity. And I think I also reminded you that as far as the FL is concerned, this is to be netted from the FL amount. And as far as the equity is concerned, it goes directly in SOKI, that is retained earning. So when it comes to the financial liability, the accounting treatment is that this element will be reduced. This element will be reduced from the financial liability. And this element is concerned, this will be, you can say, directly taken to RE. Directly taken to retained earnings. It will be adjusted against the retained earnings in SOKI. Okay, so far so good. I think that's what we discussed in the previous class. Now watch me carefully, because here comes now the technical discussion with you. Now hear this carefully to me. Now the question is, now please hear this very carefully because you need to give me an answer. Now the question is, if this TC gets reduced from the financial liability, will you be able to unwind the interest at the rate of 15%? That's a mathematical question. What you have done so far, the financial liability element, this financial liability element was discounted at the rate of 15. Now you're not compounding the same figure at 15, mind you. You took the present value of all the inflows, all the outflows interest. Now you are not compounding the same figure. You're not compounding the same figure. You are going to reduce this by 10057. So the mathematical question is, you took the present value of the interest 502,830. Now you reduce the figure. So can you compound this at the same rate of 15? Yes or no mathematically? So think about this, and I think I get the answer, no, we cannot. That's right. Because once you've reduced this financial liability, then in that case, the same rate cannot be used. You know, when this kind of a question came, I tell you, it came, I guess, if I rightly remember, in June 2019 examination question, I think. At that particular stage, the new EIR was given. So when there is going to be a transaction cost which is going to be netted in terms of FL, the same interest rate cannot be used as a compounding rate. So we will be requiring a new rate. In that questions in June 2019, that rate was already given, but you can calculate the new rate. You want me to take the new rate or give you the inputs, how that new rate is going to be computed? So I've got two choices. Either I directly tell you that this is the new rate because of the impact of the TC, or I tell you how is the new rate going to be computed. So what do you want me to do? So please give inputs on that. Okay. So I think I'm going to give you inputs on that. Let's see how does it work out in this case. Okay, so let's give you the insights. Now, in order to calculate the new rate, because TC stands deducted from the FL. Now, what do you need to do? You need to look at things from the investor's perception. You need to think of the investor's perception and make a deal getting the inflows outflow from the investor's point of view. Organize this entire deal in terms of the inflow outflow from investor's point of view. So what I'm going to do, I'm going to organize the deal. I'm going to organize this deal and look at the data in terms of the cash outflow and in terms of cash inflow from an investor's perspective. So when I say I'm going to look at things from the investor's perspective, I am looking at number one, that at 0 point of time from the investor's point of view, only for the FL. So we can say he invested this money 502,830. So he invested this money 502,830. And we said we net off the transaction cost from here. So we can say, let's get the net outflow. So we can say 502,830 minus 10057. The net figure is 492,773. And in this particular case, we can say we are going to get coupon rate of interest for the next 5 years. So how much is the interest we are going to get for the next 5 years? And that's already calculated. And that is 10% of 15 lakhs. So this is the inflow, 1,50,000 every year. This is the inflow. Now you can see this on a mathematical, finance front as well. Earlier you said 502,800 is the outflow, and you said 150 is the inflow for the next 5 years. You get a 15% rate. Now you're reducing the outflow. Now you're reducing the outflow with the inflow same. You're reducing the outflow with the inflow same. So is the internal rate of return going to increase or decrease? What do you say? Think mathematically. Earlier you took that 502,800 as outflow and the inflows. Inflows are the same, but the outflow goes down. So with the same inflows and reduced outflow, is the internal rate of return going to increase or decrease? And that's right, it will increase undoubtedly. So in this particular case, I just need to locate the internal rate of return in this case. Now, how would you calculate the internal rate of return? Just the way you do it in finance. Just use a hit and trial technique and do this. Now, I know at 15%, we are now going to get a positive NPV. Because if your outflow gets reduced by this figure, I know that at 15%, this is the NPV. I know this in advance. Because if you calculate the NPV at 15%, you're going to get NPV 10057 for sure. So maybe we can try that at 16 or 17%. So let's do one thing. Let's calculate the NPV. I think for a safe side, though I know that at 15%, I'm going to get NPV 10057. What's the harm? Let's still calculate. Because when you create an internal rate of return, you always create a range where you need to get a positive NPV at a low range and a negative NPV at an upper range. So let's do one thing. Let's organize the NPV. So I'm going to consider the present value of cash inflows and the present value of cash outflows. Let's see this at 15% and also at 16%. Hit and trial is what we're using to get the data. So let's see at the rate of 15%, this was 1,50,000 and this was 3.522 and this was 492,773. 492,773. We just need the factor at the rate of 16% in this case, 5 years. So 1 divided by 1.16, 1, 2, 3, 4, 5 GT. 3.27. This is 3.2743 rounded off. So what I've done, I've taken the calculations of NPV at 15 and at 16%. So did you get a positive NPV at 15 and a negative NPV at the rate of 16%, and then interpolate. Apply a unitary method in terms of calculating the revised IRR. So the first one, of course, we know, but I'm still just making the calculations for easy convenience. This was 3.3522. This was 3.3522. So this is going to be 1,50,000 into 3.3522 minus 492,773. And as I already said, this is going to be the NPV at 15% for sure, which is the TC. And this is going to be 3.2743 into 1,50,000 minus 492,773. This is coming positive 1628. Sorry, negative. This is coming negative 1628. Rest you know that once you calculate the NPV positive on 15, negative on 16, the IRR is the point between 15 to 16 because the NPV is going to be 0 in between. So you can now use a unitary method, or what you call an interpolation in technical terms, and get the IRR. So I think what I need to do, first of all, I need to go to the midpoint. That is where the NPV is 0. So let's first take the difference between the two. So 10057 plus, because it'll become minus minus. So plus 1628. The difference in this case is 11,685. So we can apply a unitary method in this case to calculate the IRR. So we can say the IRR is supposed to be 15% plus. This is the difference for 1%. 11,685 is the difference for 1%. So what is this percentage representing? So we can say it's going to be 10057 divided by 11,685 into 1%. Apply a unitary method to this. So we can say that this is the difference for 1%. What is the difference for 10057? So apply the unitary method. 11,685 is for 1%. So 10057 is for what part of the percentage? And you get the results. So 10057 by 11,685, this is coming to 15.86%. This comes to 15.86% in this case. Wow. So now you would have got the treatment that how the revised internal rate of return is going to be computed. Now it is this particular rate which will be used for the purpose of doing the calculation of the finance charge, the unwinding. Because earlier when you did the discounting, it was 15%, but you can't now compound at 15 because you've reduced the TC from the FL. Because the FL stands revised at a new figure, you need a revised rate to compound it back. And this is based on the new calculation that you reduce the TC, get the net proceeds, and then calculate the internal rate of return. Did you get the insight how the treatment of TC will impact the calculation of the new internal rate of return? Got it fundamentally clear? Okay, so now I think let's go forward and let's, I think, now look at the other inputs as well. Yes, that's wonderful indeed. So how we compute a new rate? Okay, I think that was the previous message. I think we have done that. How we calculate the new rate? Okay, now we need to come back. Now we need to come back on the leisure account. So in this particular case, let's come back on the calculation of the financial liability leisure. So I'm just going to first make a leisure account for understanding. Let's see the financial liability leisure, and then equity, you know what is going to happen. By the way, let's put a question to you in advance as well. Will there be any balance left over in this leisure at the end of 5 years? Or can I say it will become 0? That equity component will be split between equity share capital and the share premium at the end of the 5 years. Is my thought correct? So you're going to divide the equity component at a later stage between the equity share capital and the security premium. This amount, this ledger account will get finished at the end of 5 years because this represents only the interest element to be paid. Got the point, right? So let's go back and let's consider this as the net amount. So by bank, this is supposed to be 492,773. 492,773, which is the reduced figure. So now when you go to calculate the finance charge, to be very safe, let me put the question again. Are you going to consider 15% or are you going to consider 15.86% to calculate the finance charge? Tell me. When I'm going to consider the finance charge in this case, are you going to consider 15? You cannot, because you've already reduced the financial liability and therefore you need a new rate to compound it back. And that's right. So let's take the finance charge at the rate of 15.86%. So 492,773, 15.86, that works out at 78,154 approximately. And of course, we made a payment and that is 1,50,000 every year. The interest is being paid at the rate of 10% on the proceeds of 15 lakhs itself. And you get a balance CD as a balancing figure in this case. And this will continue for the period of next 5 years. I don't think so. You want me to make the ledger account for the next 4 years, but you still have got a choice. Do you want me to make a ledger account for the 4 years? Or I think that's manageable, then we can skip that part. I think we can skip that part. But still, you can decide if you want. I will do that. So this works out at 420,927. This becomes the balance BD in the next year. That is 490, 420. This is going to be 4,20,927. And this will go on again, so on and so forth. So I think, yes, somebody said, yes, I need 5 years. And so please complete this. Okay. I think everybody's got scared on, what I did in the previous class. I said, you want me to continue? And they say, no. And nobody wants to take chances on that. Okay, perfect. So let's do the calculations quick. So we've got finance charge. We take the bank figure, get the balance CD as a balancing figure. So we also need to make another 3 years as well. So let's continue with the leisure. 1 year, another 2 and 3. So it's all about computation now. So 420, 927, 15.86. This is 66,759. And this is 1,50,000. So let's get the balancing figure. This works out at 337,686. And this becomes the balance BD 337,686. Again, take the finance charge at 15.86. 53,557. You again make the payment, that is 1,50,000. Get the balance CD, balancing figure 337,686. This works out at 241, 243, 241, 243. And then we take the finance charge. That's 38,261. We get the payment, that is 1,50,000. And we get the balance CD, again, balancing figure. That works out at 129,504. So this is balance BD 129,504. We can take the finance charge in the last year as a balancing figure, and we can just pay off the money. So 1,50,000 is paid. So let's take the finance charge as a balancing figure. That's 20496. This should be approximately equal to 15.86%. Yes, it is almost coming similar. If you calculate 15.86%, it is almost same. There is a difference, and that is attributed to, a difference of 43 rupees, decimal places, that's fine. This is how the ledger account of the financial liability element looks like at the end of the 5th year. And what do you do now in terms of this equity? What do you do in terms of equity? Can I say the equity element? Can I say this equity element which is there with us? This is going to be divided in terms of equity share capital and share premium. Can I say at 5th year end? So this will be divided between what is the face value of the equity shares. I think we were allotting around 5,000 shares of 10 each. So that face value goes to the share capital and the rest becomes a security premium at the end of the 5th year. So it gets shifted into the equity share capital in the balance sheet, and portion of the premium goes in the tab number 2. Right, friends, I think now you've got a complete insight of the split accounting and the agenda of the TC. Now we need to be very clear that, okay, what is the role of the TC in terms of CFI? So far, so good. My agenda number 1 is done. My agenda number 2 is done. My agenda number 3, issue number 1 is done. Now I'm going to go to the agenda number 3, special issue number 2, early redemption. What is very important is, since we're standing almost now today on the 4th session on financial instruments, you need to be very clear. The journey started in terms of 3-step model. How to identify its equity, its FL, it is CFI, and then the 3 versions which I gave you till the derivative point. Then the focus turned to accounting of CFI. And in terms of CFI, we've got all these agendas. So that is how the Ind AS 32 stands organized. Okay, so far so good. Let's, I think, go further now. So I'm now on my next agenda. So before I go to the next agenda, I just want to give you a little input so that we are continuously updated on our thoughts. I'm just taking you back on the study material. Unit number 3, just to keep you connected in terms of the thought. So nowhere we are lost in between. So I'm just going to take you back and show you the inputs, so that we're absolutely connected before we go to the next agenda in hand. Okay, so let me just, I think, quickly take you on the study material out here. Let's have a look at this. We've done these illustrations. I am just connecting the dots back to you. So if you look at the inputs in terms of this illustration, we've done illustration number 25. We've done illustration number 25, wherein we saw the concept of redeemable and discretionary dividends. Agenda number 1, identifying one component equity, another component FL, identifying CFI. Done. Then we went to the illustration number 2, perpetual loan. Agenda number 1, the second category, perpetual loan, depends whether coupon rate and market rate is same or not. That's done. Then we came to the illustration number 27. Then I came to the illustration number 27, and in terms of illustration number 27, we were talking of optionally convertible, and that was the third case in agenda number 1, which has got a derivative embedded, and we said the derivative, if it is equity, is not segregated. Done. So these were the 3 kinds of questions we saw. Then we started working on the agenda number 2. And in terms of agenda number 2, I gave you perpetual loan accounting. I also did an illustration on optionally convertible debentures with you. because I took my own example and I said this can be done on the same line. So this was the agenda number 2, split accounting for optionally convertible as well as you can say perpetual loan. And then I added a few questions on my side. In this particular case. And I added the concept of partially convertible, compulsorily convertible. I added those questions. I added the TCs, etc. Now, there is another illustration 30 in this unit and 31, which can be managed. Now we come to the special issue. Now we come to another special issue in this particular case. And that is the agenda number. That is the agenda number 3, special issue number 2. So watch this now carefully. This is what we need to discuss now. Illustration number 32 of the study material. We're now on the illustration number 32 of the study material. So let's come back on this agenda, illustration number 32. So now let me tell you, we are on agenda number 3, repeating that again, agenda number 3, special issue number 2, and that is early redemption. Now this is another special case. Watch this carefully. It's again the case of optionally convertible debenture, preference shares, and I am given the data. So there is cash flows given. There is already a chart given, the equity element, everything is given. Assume that D has got an early redemption option to prepay the instrument at 11 lakhs and on 30th June X3. It exercises the option. On 30th June X3, the interest rate has changed. At that time, D could have issued a 1-year maturity on 30th June non-convertible instrument at 5%. Now you will say, so what is this? I'll now tell you. In this particular case, if you remember the case of optionally convertible instrument, I told the holder, you've got an option to come to me at any time and take the money. I told him that, okay, you can convert this into shares at any point of time. So we are now looking at a premature settlement. The special issue is a premature settlement that you tell the holder, before the maturity period, you take this money and let's finish off the deal. You take the money and let's finish off the deal. Now, the money which you go to pay him may not match. The money which you're going to pay him may not match with the inputs in terms of the book value of the FL as well as the book value of the equity. You may land up paying more or you may land up paying less. So how do you tackle the difference between the book value of that equity FL and the amount which you pay? So we're not able to understand this. What you're saying is getting more technical bit. Okay, let's do one thing. Let's give you some additional facts. I think we'll come back to this illustration. Let me give you an example of my own so that we become very clear on the agenda. So what I'm doing, I am giving you my own example on this. So let's first put the heading. We are on agenda number 3. We are on the agenda number 3 and we are discussing the special issue. We are discussing the special issue that is called early redemption. That is called early redemption of CFI. So I'll give you my example to illustrate this. Then we can come back to the illustration 32 and you will be able to manage that illustration very well. Okay, so I think let's underline out here. Okay, so let me now give you a facts of the case. I'll give you some details of my own and then we'll solve this out. Okay, so let me just give you some data. I am giving you an example of my own. So I'm giving you an example of my own. Let me give you the data points and we'll work on this. So let's say on 1st April X4. Let's say on 1st April X4, let's say a company issued 8% convertible debenture. And let's say that's 5,000 in number. And let's consider this is got a face value, which is to the extent of 100. That is the face value. So the company issued a 8% convertible debentures. That was on 1st April X4. And let's consider the maturity is 31st March X9. This is the maturity, which is a period of 5 years in this case. Okay, and I'm also given that the company in this case is, let's say, they're convertible into equity shares at 105. So let's give you that they are convertible. They are convertible into equity shares. They are convertible into equity shares at the rate of 105. So at a conversion price, so this is at 105, this is the conversion price. So the holder is given the option that he can convert this at the rate of 105 per share. Let me also give you the interest on a non-convertible debenture, interest on a NCD, non-convertible debenture, let's say is to the extent of 12%. This is one part of the data. Let's give you more data. So now let's say on 1st April X7. Now let's consider on 1st April X7, which is after a period of 3 years, on 1st April X7. So the fair value of this convertible debenture, the fair value of the convertible debenture is 5,25,000, and the offer is made to the debenture holders that you can take this money. And I'm also given the interest rate. I'm also given the interest rate on non-convertible debentures at this date, which is for a period of 2 years, and that is, let's say, 9%. Okay, that's the data. Okay, so let me just, give you the inputs once again to keep it simple and straight. A company issued a convertible debenture on 1st April X4 with the following terms: that you've got a maturity 5 years and they're convertible into equity shares at the rate of 105 per share. And the interest rate on a non-convertible instrument is appearing at 12% on 1st April X4. Now on 1st April X7, the fair value of the convertible debentures is given, and we made an offer to the debenture holders that let's give you this money and let's redeem your convertible debenture. And the interest rate on the non-convertible debenture prevailing for the next 2 years of maturity is 9%. Now let's forget about the early redemption. Let's, do one thing. Let's first do the split accounting. Let's make the ledger account up to 31st March X7. Up to the date when the offer is made to the debenture holder, let's do the usual accounting and then we'll see what is to be done. Let's, go further. So what we're going to do, we are going to do a split accounting. This is the split accounting which is being done on 1st April X4. This is the split accounting which is being done on 1st April X4 on the initial recognition of the CFI. Let's look at the proceeds and split. So my proceed is 5,000 into 100. The proceed is supposed to be 5 lakhs. The proceeds in this case is 5 lakhs. 5,000 and each debenture is 100 each. And let's do the split accounting. Let's divide this between the financial liability and the equity. Now we are considering this to be a case where we can say that we are considering this to be optionally convertible. So what is going to be the financial liability element? Are you going to consider both the interest and the principal? What do you say? I am considering that this is optionally convertible in nature. If it is optionally convertible in nature, so when you consider the financial liability, are you going to consider the interest and the principal both put together? So let's get the data from your side. And yes, that is correctly said. Yes, we're going to consider both. Wonderful indeed. So let's, identify what is the interest element. So on 5 lakhs, we're going to consider 8%. So on 5 lakh rupees, we're going to consider 8%. And let's get the PVIFA And the coupon rate on non-convertible is at 12%. So let's see 12% for a period of 5 years. And we're also going to consider a repayment of the principal money as well. And the principal money is going to be paid at the rate of 12% fifth year end. Now, don't get confused on that 105. Many people have got a tendency to get confused at 105. That is a conversion price for converting the number of shares. It's not the premium which is payable on redemption. So don't by mistake consider that you're going to take 5 lakhs plus 5%. No, that 5% is not a premium. So let's see what is at 12%. 1 divided by 1.12. 1, 2, 3, 4, 5. So this is going to be 4 decimals, 0.5674. And this is going to be 3.6048. This is 4 decimal places, the interest factor. Let's see what is the present value of the interest and the principal. Then we can take equity as a balancing figure in this case. So 5 lakhs at the rate of 8% into 3.6048, 144, 192. 144, 192. I think it's coming to 427. It's coming to 427, 892. Just see if the calculations are correct. That's 427, 892. And the balancing figure is the equity 72,108. That becomes a balancing figure, correct? Okay, so this is done. I think this gives me the initial accounting, nothing different from what you have done. This is the split accounting on 1st April X4. Now what I'm going to do, I'm going to make my leisure account for the financial liability for the next 3 years before the offer is given to the debenture holders to repurchase, to redeem the debenture. So let's do one thing. Let's make a leisure account of the financial liability. So let's make the financial liability. So this is by bank. So the financial liability is 427,892. And there is no TC. Had there been a TC, then this would have complicated the agendas further in this case. But there is no TC in this case. So let's take the finance charge. And this will be at what rate? 12%. So 427,892, 12% would mean 51,347. And we make a payment at the interest rate, which is supposed to be 40,000, 5 lakhs into 8%. We get the balance CD as a balancing figure. So we're just making this ledger account for a period of 3 years to get the status of the financial liability as on the date of early redemption. So 427,892, 51,347 minus 40. This is 439,239. This becomes balance BD 439,239. Let's take the interest. So this is 439,239. The finance charge at the rate of 12%. 52,709 approximately. We again make the payment, that is 40,000. We get the balance CD as a balancing figure. So 439,239, 52,709. This is 451,948. So 451,948. Again, take the finance charge at the rate of 12%. 54,234. 54,234. We again make the payment to the extent of 40,000 and get the balance CD balancing figure. So as we're going to proceed in financial instruments, you're going to see a lot of computations taking place. So you'll be doing a lot of calculations also. 451,948, 54 to 34 minus 40. That's, I think, 466,182. I hope, friends, my calculations are correct because I'll need all this. So I hope the calculations are going perfectly well. I think so. Now, we have not done anything different as compared to what we've done so far. We've just done the split accounting. One, we made the leisure account up to the date of early redemption. Two, nothing special done, nothing special done. Now, let me just note down the data. So what we are now doing, that on 1st April X7, that is the date of early redemption. That is the date of early redemption. What am I supposed to do on the date of early redemption? Organize the figure. So we've got the financial liability and we've got the equity component of the CFI. Let's organize what is the book value. Let's organize the book value. So what you've done, you've so far made the calculation of the book value of FL as well as equity. Just organize the data. That's it. So as far as the financial liability is concerned, 466,182, 466,182, and the equity would remain the same, what we calculated earlier, 72,108. That remains the same. No changes because that would continue in tab number 1 consecutively. So that remains the same. Now, what do we need to do? We made an offer to the debenture holder that you take 5,25,000. Please hear this carefully. It's just a matter of few things that should click you. Now, we made an offer to the debenture holder that we're going to pay you 5,25,000. So this 525 is paid for the equity and FL put together. So am I supposed to split this 525 in terms of what is paid towards FL and what is paid towards equity? Yes. So when you go for an early redemption, what do you need to do in this particular case? The offer price, which is 525, is to split between FL and equity. But how do we do the split? Do the split accounting exactly the usual manner. But remember, at this stage, the split accounting will be done on the rate which is prevailing on a non-convertible instrument with the same maturity. Now, this is something which I want to stress. Watch this very carefully. Originally, we issued a convertible debenture on 1st April X4, which is maturing on 31st March X9. Originally, we issued a convertible debenture, which has got a period of 5 years of maturity. So this is the original maturity date. This is the original maturity date. We made an offer in between on 1st April X7. And we said we'll go for early redemption. Now, I need to see that if you would have issued a non-convertible debenture with the same maturity date. We need to put a question that if you would have issued a non-convertible debt on the same date with the same maturity date. Now, there is another 2 years to go. Since there is another 2 years to go, we need to find out that if you would have issued a non-convertible instrument which is going to mature on the same date as the original maturity date, then what is the coupon rate in this case? And that's what I gave you. I said the interest rate on a non-convertible with a 2 years maturity is supposed to be 9%. And that's the reason the 2 years is given, because we need to get the coupon rate on NCD, which has got the same maturity date as the original convertible debt. So we're going to consider this 9%. So what we're going to do, use this 9% for the purpose of split accounting. So take the proceeds again. What are the proceeds now? 5,25,000. And split that between the FL and the equity. So we do another split accounting at this stage. So the proceeds are the fair value, the offer price made, and this is to be divided between FL as well as the equity component. It's all about systematic calculations. So which means on early redemption, you'll see a split accounting at the inception. And you're going to see another split accounting on the date when the offer is made. But this time when you calculate the FL, you need to now consider the remaining obligations, the remaining interest and the principal, but discounted at the non-convertible rate, which is for the same maturity date as the original one. So let's calculate this. So what was the coupon rate we were paying? So we were paying on 5 lakhs 8%. So we were paying on 5 lakhs at the rate of 8%. Now we need the cumulative factor 9% 2 years. And we're also going to pay that 5 lakh rupees. We need a discounting 9% second year end. So let's see what is the factor. 1 divided by 1.09. This is 0.8417. This is supposed to be 9% second year end. This is 9% second year end. And this is 1.7591. So we can calculate what is the financial liability element. So remaining obligations discounted at the rate of 9%. Let's see the results. So 5 lakhs into 8417, 428.50. 428.50. This is, I think, coming to 491,214. Just check the calculations if this is correct. This is coming to 491,214 minus 525. The equity is the balancing figure. 33,786 is the equity element. Wow. So what we have done basically now, we've done the split accounting, segregating the offer price, the fair value in terms of FL and equity. Now you can compare the split proceeds. So we've got the fair value. We are given the fair value, which is split in two elements. This is 491,214, and this is 33,786. Now it's all about making a comparison between the two. Now, let me ask you a simple question based on this calculations. This is the book value and this is what you're paying them. You're paying more. Is it a gain or a loss? Of course, it's a loss. And against the equity component, this is the book value and you're making a payment lesser. It is supposed to be what? Can I say this is a gain? So this is a loss. And this loss will be taken in the P&L, and this is a gain, and this gain is going to be taken directly in terms of equity. That is so key, directly in terms of statement of changes in equity. And if you ask me what will be the journal entry, I can give you the journal entry as well. The entry in this case is the financial liability gets a debit and the bank gets a credit, and the difference goes in the P&L debit. The equity component is shifted. You can say this tab 1 will close and this money is bank credit and this gain goes in the tab number 2. But of course, you can show the workings itself, but this is for your understanding that this case, this is the FL debit and this is the bank credit and this goes in the P&L. This is tab 1 gets eliminated and this is the bank figure and this is what is going to go in the tab number 2, retained earnings. Let's see what is the gain loss. So this I think works out at 38,322 and this is 466,182 minus 491,214. This is 25,032. Wow. So this, I think, takes care of the special issue number 2 as well. The special issue number 2, which is a case of early redemption of a CFI. I hope, friends, you've got the things clear. Ind AS 32 gets over on that. Ind AS 32 gets over on that. We've covered the aspects of identifying the nature of the instruments. We've done with the concept of CFI and its complete accounting with all the special issues in hand. Okay, I think I got a question now. So why do we take 5 lakhs to split instead of 5.25? Well, this 5 lakhs which was taken earlier, was on the date of issue of the convertible debt. That was for initial recognition. And then you made a ledger account up to 3 years, which is up to the date of redemption. Now, this calculation which we're doing is being done on the date of early redemption. Now, you told the person, the debenture holder, I give you an offer of 5,25,000 on this date. But this 525 is an offer towards both equity and the FL element. And it is necessary to split the difference between FL equity, because whatever gain loss will arise on the FL component will be taken to the P&L. But whenever in terms of Ind AS, any gain or loss arises on an equity transaction, it never goes in the P&L. If there is any gain or loss arising on account of equity, it is always directly taken to the RE. So in this case, it is necessary to split that 525 into two components. So this split accounting pertains to the date of early redemption, which is to segregate that 525, that what is paid towards FL and the gain loss in P&L, what is paid towards equity and the gain loss goes in terms of RE. Then he says, sir, could there be a possibility that interest on NCD is less than 8%? How do we account for this? 8% in the sense you're talking about the initial split accounting, that you say that the interest on a non-convertible instrument happens? Well, generally, no. Let me put that question to you. As a debenture holder, if I am giving 8% to someone on a non-convertible instrument, do you think I'm going to give him more than 8% on a convertible option? Then who will buy my non-convertible instrument? Let me put that question to you. I tell the person, you don't get a conversion option. I give you 8%. Even if you go for a conversion option, I give you 10%. I'll say, boss, give me 10. Why do I need to go for 8% in that case? You getting my point? So the question of giving a coupon rate on a non-convertible below is fine, more than convertible is fine. But giving them, below 8% is going to be scary. Why would anybody buy a convertible debt, which is got a coupon, why would somebody buy a non-convertible debt, which has got a coupon rate which is less as compared to convertible? I'll always say, hey, give me convertible. I'm getting my bread buttered on both the sides and I'm going to eat it as well. You got my point. Okay, so I think that was the two questions. No, sir, for early redemption at a maturity period. Okay, so let me also put it like this. So now you're saying that we're looking at the coupon rate, which is, let's say in this case, this turns out to be below 8%. Well, it can be. I don't deny the possibility at that stage. When you go to study financial management, that is advanced financial management, AFM, you're also going to see that there is a concept of early redemption of bonds, which you study. And in case of early redemption of bonds, what happens is the company has borrowed the money at a high rate of interest. And the prevailing coupon rate, which is there, is much lower. So the company is, speculating and deciding that let me redeem my existing bonds and let's go for a fresh issue of bonds. So I don't deny the possibility that over a period of 5 years, during the course of maturity, as a company, I might realize that the interest rate which is payable today is massively declined. So why I am retaining funds at a high rate of interest? So the question of an early redemption stems out of the fact that yes, there is a possibility for that. So I don't deny that possibility, that on the redemption date, if your coupon rate has massively gone down, I don't deny that possibility. All right. I think you will have got your answer on that. So this was one inputs. Okay. I think I'm getting another inputs or the answer. Okay, that was there. And I think I got another input. So 8%, 50,000 redemptions. Now exist 525 will continue for another 2 years. Okay, that was the data you gave. Okay, right. So I think that answers the questions in that case. Wow. So we are now done with the concept of Ind AS 32, giving you all the special agendas now. Now we're ready to push to the next standard, that is Ind AS 109. Though, let me also tell you one thing, because as you're going to run the pages in the study material, you'll say, so there is something, which you missed out at this stage. So let me also give you some insights on what I am not discussing at this stage. And since it has not been, even touched in the exams, I want to make the best use of all available time. So I'm not getting into that part of the stage, but I'll still tell you what is given in the standard. Before we close 32 formally, let me tell you another input as well. So if you look in terms of Ind AS 32, and our perception has been typically the issuer point of view. Now, please hear me carefully, because this is another interesting agenda which is given. But, I don't want to get into that thing at this stage, because it may disturb the flow of understanding as well. But I think at the same time, as you go to turn pages in the study material unit 3, you're definitely going to find this. Now, we have seen from the issuer point of view, that there are basically four kinds of instruments. One is what you call a financial liability. One is what you call an equity instrument. One is what you call a compound financial instruments. And the other one is what is called a hybrid instrument. So this is what we have seen so far. Now, there is another very interesting discussion which is done in the study material. And apart from this, they have discussed what is called deemed equity instruments. It's called deemed equity instruments. Now, please hear this carefully. I don't want to get into this at this stage, but at the same time, give you the thoughts what are discussed out here. The concept goes like this, that when a company, let's say, issues instruments, and in this particular case, certain instruments have got, you can say almost the characteristics of an equity instruments. They've got characteristics almost of an equity instruments, but they do not 100% meet the criteria of an equity instrument. So what the standard did, that, certain companies may have no pure equity instruments. Certain companies may have no pure equity instruments. In those cases, they said, let's pick up certain instruments in your company. Like, for example, mutual fund companies. The mutual fund companies may have units of mutual fund, and they may not, meet the criteria of a pure equity instrument. So what the standard said, that in certain entities, you will not see any pure equity instruments. So what you can do, you can pick up those instruments which are as good as equity. Don't treat them as equity, but present them as equity. Mind the words, don't treat them as equity instruments, but, consider them, present them as equity instruments. So they gave the concept of deemed equity instruments, which are as good as equity instruments, and therefore they can be presented, only presented, not otherwise. Therefore, they can be presented as equity instruments in the balance sheet of the issuer. So they said, we're looking at certain kind of instruments which are supposed to be as good as equity instruments, and therefore they can be presented as equity instruments in the balance sheet of the issuer. And they said that in this particular case, they gave some inputs in terms of para number 16A, in terms of para number 16B, in terms of para number 16C, and in terms of para 16D. They were very strict in terms of the fact. They said, we're going to give you a lot of conditions in para 16A to 16B. So they said that you can present them as equity instruments in the balance sheet if the conditions in these paras are met. If the conditions in these paras are met. If you can fulfill the conditions which are given in these paras, then they can be presented as equity instruments in the balance sheet of the issuer. So this is, a discussion which is done in the unit number 3. Fortunately, unfortunately, I don't remember being touched in the exams in this case. But, I just wanted to make it clear that this part is given. Now, I don't want to get into all this at this stage, because that could, disturb the flow of understanding. But I think I've just given you the basic input. So what has been done on all these conditions one by one, there has been a small little illustration which is given. That is one agenda which is there in terms of Ind AS 32. So you can take this as more like a special issue. That's more like a special issue which is given in terms of Ind AS 32. But as I said, we don't want to get into this so that the flow doesn't get disturbed on that. So let's keep it aside. So Ind AS 32, your main learnings are on identifying these instruments and the accounting of these instruments. So we have done the identification and we've done the accounting for these kind of instruments. Now, before we proceed further, friends, on Ind AS 109, sometimes, of course, you remember, I always keep asking your comfort zone scores. So based on your cumulative revisions and what we have covered so far, I want you to give yourself a score on 10. What is your comfort zone on a scale of 10 on Ind AS 32 so far? Let's see. Then we're going to start a journey on Ind AS 109. Wow, I get a quick score, 10 by 10. That's brilliant indeed. And so we accounted for in the same manner and ascertained the gain or loss. Yes, I think for the previous trail which you're asking, absolutely correct. 9.5, I get the next score on this. That's great. 9 is the next score I get. So 9 out of 10 need more practice on my part. I think 9 out of 10 and 9.5 is perfect indeed. Once you're going to do the consolidated inputs, you're going to become very good hang on this. Okay, now let's proceed further. Now, I think at this stage, it is first of all important to showcase, how we're going to proceed in 109. Because I think since now it has got so many agendas, I think it's important to first of all, give you some basic inflow that what is the trailer looks like. So I'm now going to give you first of all, a very basic idea. I am just giving you first of all a basic idea at this stage on the flow of Ind AS 109. So we're now formally starting with 109, and I want to give you a basic idea on the flow of the standard because we need to be connected, because this is now going to contain a lot of issues and we need to be connected in terms of how the flow is going. Okay. So at the first instance, what we are going to do. Till now, the focus is being completely on the issuer, and now my focus is shifting on the holder. For the time being, I'll come back to the issuer as well. But as we start off the kick-off Ind AS 109, my focus is now on the holder. Of course, we'll come to the focus on the issuer as well, because we're yet to discuss the accounting of financial liability. We don't need to do the accounting of equity instruments, accounting for equity shares, you know it very well. So we're not learning the accounting for equity instruments, but the accounting for financial liability is pending. So what we're going to do at the first instance, we will look into the accounting. So we will look into the accounting of the holder. So we will say, okay, how does the financial accounting is recognized? How is the initial recognition takes place? How is the subsequent accounting take place? So focus will be completely on the accounting of financial assets. Our focus will be completely in terms of accounting for financial assets. And there is a lot of things to be done in terms of accounting for financial assets. This is going to take a lot of time in terms of things, because there are, a bit of, you can say, left, right places of gullies also where we need to go. And here also we're going to look at the accounting of financial liability, where we will see how the initial accounting and the subsequent accounting in terms of liabilities is done. So there will be some special issues coming in between, but the focus is now on the accounting of a financial asset and accounting of a financial liability. Now, moving forward. Once this area stands done, then we've got certain special issues of discussion. Then we've got certain special issues of discussions in the standard. And the special issues on the standard is, typically, I would say 3 to 4 cases what we need to do. Number one, the special issue is one is we need to understand the concept of what is called impairment of financial assets. The first special issue is to understand the impairment of financial assets. The financial assets are also going to be done impairment testing. You've already done a standard on impairment testing, that is Ind AS 36. That standard typically deals with non-financial assets. The standard setters in Ind AS have divided the impairment in terms of 2 different standards. When you look at a non-financial assets, the impairment testing is done under Ind AS 36. And when it comes to financial assets, the impairment testing is done under Ind AS 109. So that is one special area which we need to discuss. The second is derecognition. The second is the derecognition of financial assets and financial liabilities. Because this is like recognizing the financial assets and liability. So we need to understand, when does a derecognition take place? Derecognition means removal of the financial assets and removal of the financial liability from the books of accounts. So we will see what are the principles and the entries which are done when the financial asset and liability is derecognized, removed from the books of accounts. That's another special agenda. The third one is a very interesting issue, and that is called hedge accounting. So hedge accounting is something, which involves the application of derivatives as well. And we've already covered the derivatives. So hedge accounting is optional for the entity, but then we need to understand how the hedge accounting is done. That's another area. And then there is also the accounting in terms of what we call embedded derivatives. That if there is a derivative which is embedded in the financial instrument, how does the accounting for the embedded derivative take place? So you can see that, we've got a total of 6 issues in hand. So I've just given you the basic idea so that your mind keeps flowing in terms of how we are covering this standard. So our focus will be accounting for financial assets. Second will be accounting for financial liabilities, and then these 4 agendas. So once those 6 issues are done, you will get more idea on this. Now you must be thinking, aha, so we got the idea. You've got 6 more sessions. You're going to devote like 1 session on each of these issues? No, not necessarily. Because these may not take 1 class each, but of course, derecognition takes quite some good time. So this might be almost like, 1 class or more. Hedge accounting, embedded and impairments would take, another little toll as well. But our main areas of focus, this is 1, this is 2, this is 3. We'll go not very deep, but yes, a little more than the exams, on these areas as well. Time permits, we're going to do that. So this is how the framework of Ind AS 109 gets adjusted, just to put it in your minds. Now let's begin with Ind AS 109. So on this formal introduction now, I am coming to Ind AS 109. And as we said, this is financial instruments, recognition and measurement. This is recognition and measurement. Now, let me tell you, friends, today and of course on the next class on Saturday, you are going to get a huge framework in terms of the standard. It's going to be a very crucial class where you will be able to learn the main nitty-gritties on the standard. I am going to conceptually create your base. So that means the level will further increase? Yes. So you mean to say more than what we have done so far? Yes. Are you scaring us, sir? No. I'm just telling you, there is a difference between scaring and telling people. Sometimes people hear and they feel scared. Don't get scared. I'm with you. And trust me, you're in safe hands. Say yes. I am the financial doctor with you right now. You need to trust your doctor. You're in safe hands. Say yes. Okay, so I'm still waiting for a yes coming on that side. I said yes, so I think people send me a smiley on that, but didn't say yes on that. Okay, I think I got a good message at least, somebody said yes on that. That's great. Yes, definitely you are a financial doctor. That's great indeed. Okay, so I think let's take the journey. Okay, so let's, I think, go forwards. So say but would have more doubts, you are definitely most welcome to put your doubts across. Okay, now let's introduce the standard to you. First of all, we're going to focus on the financial asset. And since I need to develop certain concepts, which I'm going to do slowly and steadily, let me first introduce you that I am focusing on the financial assets. I am focusing on the concept of financial assets. And let me first of all tell you that when I look at the financial assets, my focus is right now not on the recognition, but on the measurement aspect. So we've got the initial measurement and we've got the subsequent measurement. Because whenever I look at assets, for that matter, any assets, whether it is financial or non-financial, when it comes to the accounting, as far as any assets are concerned, my mind always flows on the concept, how do you initially measure them? How do you subsequently measure them? So now let's make it very clear. Financial assets are initially measured at a fair value. All financial assets are initially measured at a fair value. Unlike your non-financial assets like PPE, investment property, intangible assets, which are all initially measured at a cost model, financial assets are all measured at a fair value. But there are certain exceptions. And there are two exceptions which I'm going to give you right away. So financial assets are, you can say, measured at a fair value. The initial measurement is all at a fair value. But then there are two exceptions. Where the initial recognition is not at the fair value, but is done at what we call transaction price. One is called trade receivable. And one is called a loan, which is recoverable on demand. So there are two assets which are recorded not at a fair value. If you make a credit sale to the customer, you create a debtors, you create a trade receivable, and that is recognized at a transaction price. Now, what is a transaction price? You know that. In terms of Ind AS 115, you capture your things at a transaction price, the price which you have contracted with the customer. So in these two cases, the recognition is done at a transaction price. So leaving these two cases, all the financial assets are initially always captured at a fair value, except a trade receivable and except a loan which is recoverable on demand. Now, coming to the subsequent liabilities, subsequent accounting of financial assets, I would say it depends upon certain parameters. So what I've done, I converted those parameters into a three-step model. Aha. So Ind AS 32, from the issuer perspective, you look at a three-step model. Ind AS 109 also going to look at a three-step model. So it depends upon the three-step model which I will give you. So I will give you a three-step model in terms of understanding how the subsequent measurement is done. But at this stage, let me put some terms into your mind. After you decide the three-step model, the financial assets could be measured at something which is called amortized cost. The financial assets could be measured at what is called FPTPL, fair value through profit and loss. So dependent upon the three-step model, your asset may be measured at AC. This is called amortized cost. We call it in short as AC. Or it may be measured at a fair value. So this is like a cost model and this is like a fair value model, and this is a fair value through P&L. The financial assets will be captured at a fair value at each balance sheet date, and the changes in the fair value will be put in the profit and loss account. That's called FVTPL, a fair value through a profit and loss. Many people call it as FVPL. They don't use the word T. I use it. The next one is called FPTOCI. That means you consider the financial assets measured at a fair value. So at each balance sheet date, you're going to capture the financial assets at a fair value, and the fair value changes will be taken in other comprehensive income. So you can say this is like a cost model and this is like a fair value model. In this case, the fair value changes will not be captured. And in these two cases, the fair value changes will be captured. So when I say FPTPL, you're going to take the fair value change in the P&L. When I say FPT OCI, you're going to take the fair value changes in the other comprehensive income. Now, which particular measurement basis will be used in terms of financial asset? It all depends upon the parameters of the three-step model. The three-step model which I'm going to give you will decide, okay, if this is the combination, then this is the measurement base. If this is the combination, then this is the measurement base. So all the permutation combination depends upon the three-step model, which will decide how it is subsequently accounted. So the interesting part is that financial assets initially get captured at a fair value. Thereafter, they may continue at a cost model, and thereafter, it may continue at a fair value model. Because you can see this is something very different as compared to the other standards. Because in other standards, initial recognition is at cost, and then you either continue at a cost or you continue at a fair value. But in this case, you are taking it at a fair value, then you switch to cost, and then you switch to a fair value, and it depends upon the parameters in this case. But now the main question is to decide, what is this amortized cost all about? Now, what do you want me, friends, to do? Give you the combinations directly, tell you that if this is the combination, then this is the base, or give you the combinations with the complete logics that if this is the combination, why this particular base? If this is the combination, why the particular base? So you want the logics as well, or you just want me to give you, pen down a chart that, okay, if this combination is done, this base is done, and that's the end of the journey. So let me see, what do I get on this? I'm sure you're going to tell me logics. So logics indeed. Okay, so I think that's well taken. Okay, so that's wonderful. So I'm going to give you logics as well. So I think before we start forward further, I think it's time to give you a break as well, because we're going to develop something, some concepts first. So I'm going to show you a chart also after the break on which we're going to work upon. But we will not be able to finish that chart today. We're going to kick off a journey on the chart. And I am also going to give you some data with the help of which we're going to understand these inputs as well. Because you need to understand the concept of OCI much better. Because without the understanding of that other comprehensive income, it can be dangerous as well. So let's take a break first of all. Let's relax the minds and then start a journey on the financial assets accounting with you, friends. So we'll take a break. Commence back in 10-12 minutes, friends. Thank you. Relaxation of mind. I guess I'm getting a message. Sir, could you please upload the notes for part one, part two as well? Are they already uploaded? I guess if you were to check the portal, I think all the notes are updated. One, two, three, all parts are there. Just please check that once again. Okay, so now I think coming back to the agenda, just to give you a quick recap what we were discussing on the financial assets. So we said financial assets are initially measured at a fair value, with the two exceptions: trade receivable at a TP, transaction price, and a loan which is recoverable on demand. Other than that, all assets are taken at a fair value. Subsequently, it depends upon certain parameters which we're going to convert into a three-step model. And I said you will land up recognizing it amortized cost, or on the basis of fair value through P&L or a fair value through OCI, which means effectively either we use a cost model or we use a fair value, in which case the fair value changes either enter the P&L or the fair value changes enter the other comprehensive income. Now, there are two things which I need to develop at this particular stage. Before that, let me just show you a chart. In the unit number two, of the study material, there is an interesting chart. I'll just share that to you, so that you keep in mind that we are continuously working on that particular chart. So this is in the unit number 2 of the study material. I'm just going to share the chart on the screen to you. Unit number 2 only, I guess. Yes. So I'm not discussing this chart, but I just want you to have a look at this chart. So this is, ultimately the chart which we are working on. You can see some very interesting inputs like debt investments, derivative investments, equity investments. This is which I'm going to convert into a three-step model. So we need a lot of time, in fact, to work upon this. But you can see that in the end of the chart, there is something like amortized cost. There is something like a fair value through OCI. It says with a reclassification or no reclassification, and there is FPTPL. So we need to look at those permutation combinations. So don't get scared looking at this chart. This is what we're going to work upon. So this is what we're going to convert into a three-step model later. But at the time being, let me tell you what am I up to. I'm going to now develop two base concepts. I think first what we need to learn is what is this amortized cost. So my first focus is going to be make you understand the concept of an amortized cost approach. Now, let me, share a small little example to you. And based on that example, we are going to make our extensive discussions. Now, let's, I think, add a discussion. So right now, my focus is to give you what is the concept of amortized cost. My first concept, as I'm building my concept, is to give you what is the concept of amortized cost in this particular case. Now, I'm just going to share on the screen another input to you. So we'll be working upon that later. But for the time being, I just want to, show you something interesting. So I am just going to share on the screen a snapshot of something which you need to see and appreciate at the moment. Just give me a second. Right, so I'm just going to share a small little example to you. We're not solving this example as of now, but I just want to, show you something, and we just want to look at the deal. We just want to look at the deal, that's it. So just have a look at this example, just read this example just take a minute and just read the example. We're looking at things from the holder's point of view. And if you look at the deal, it says on 1st January, Tokyo bought 1 lakh 5% bond for 95,000, incurring an issue cost of 2,000. The interest is received in arrears and the bonds are redeemed at a premium of 5960 over the face value on December X3. And then it gives you something called an effective interest rate, which is supposed to be 8%. Now, I don't know how much of this you understood or not, but you must be making something at the back of your mind that there is a discount at the time of issue, there is some premium at the time of redemption, and there is some issue expense, and that's what he's talking about. So let's forget about it. The idea was just to show you this input. Now, what's this carefully? I'll give you an example and you need to apply your mind whether the deal will happen or not. So please be very careful. The next 5 minutes very crucial, because if you get this, you start understanding the logic. I'm going to give you two deals and you need to understand whether the two deals will happen or not. Let's take the case of two individuals, Mr. A, and let's take the case of Mr. B. Let's say, for example, Mr. A, right now I'm not looking at the, let's say, the holder. My example is focusing on the issuer. But of course, the deal is between the issuer and the holder. But, just to explain, I'm looking at things from the issuer perspective, not from the holder perspective. Now, Mr. A says that he wants to borrow 10 lakhs. So Mr. A has to borrow a sum total of 10 lakh rupees. So he goes to the market and identifies that the interest rate on this particular loan is, let's say, at the rate of 10%. So he goes and inquires in the market that what is the rate at which I can take a loan. So people tell him that, okay, if you want to borrow this money, you need to pay interest at 10% per annum. So would you like to tell me how much interest is he going to charge in the profit and loss account every year? So is he going to charge interest every year at the rate of 10% on 10 lakhs? That is 1 lakh rupee. Is my understanding correct? I think you'll easily vouch me for that. That's right. So it's absolutely a clean deal where A says, I want to borrow 10 lakhs and he pays interest at the market rate of 10% and he puts 1 lakh into the P&L as an interest. Now, let's go to the other person, Mr. B. He also goes to borrow in the market and he also wants to borrow 10 lakh rupees. And he's also very clearly told that the interest rate in the market is at the rate of 10%. But he sits down with the lender. He sits down with the other person, the lender, and he says, sir, let's make a deal. Now, please hear the deal carefully because you need to decide whether this deal will happen or not. So he sits down with the other person. He says, sir, I need a loan for the next 3 years. He says, sir, I need a loan for the next 3 years, but I will not be able to pay you 10%. So instead of 10%, I'll pay you 8% interest every year. Now, immediately the lender will say, no. The market rate is 10%. Why will I give you a loan at 8%? Why don't want to suffer a loss of 2%? So Mr. B says, no worries, sir. You accommodate me that you take 2% less every year. What I'll do, I'll compensate you this loss. He says, sir, I will compensate you this loss. How will I compensate you? He says, sir, at the end of the 3rd year. Now, what's the deal? He says, sir, at the end of 3rd year, I paid you 2% less in the 1st year, which you would have invested for the next 2 years. So I'll give you the 2% interest for the 1st year with interest for the next 2 years. 1, you suffered a loss of 2% in the 2nd year as well. I give you the 2% with interest for 1 year. And you suffer a 2% loss in the 3rd year. I'll give you the 2% as well. So I'll compensate you the 2% for year 1 with interest for 2 years. I'll compensate you the 2% interest for the 2nd year with interest for 1 year. And I'm also going to compensate you 2% of the 3rd year. So what I'll do, I'll give you a premium at the time of redemption. I'll give you a premium on the redemption to compensate you the 2% loss. Now you need to decide and tell me, will Mr. B accept the deal? Sorry, will the lender accept the deal? He's telling the person that instead of paying you 10, I'm going to pay you 8%. But he says, don't worry, the 2% which I would have given you, which you could have invested in the next couple of years, I will compensate all the interest of 2% with interest on the 2% and pay you a premium which will cover the loss of 2%. Do you think he'll agree to the deal? Tell me. After hearing all this, do you think the lender would agree to the deal? And I get the answer, yes, sir, he will agree to the deal. That's perfectly said. Because in this particular case, when you're telling the person that don't worry, I will definitely compensate you. I'm saying I will definitely compensate you for the loss of interest, the other person would agree to the deal. Now tell me, in this particular case, if this deal happens, what is the interest which Mr. B is going to record in the profit and loss account? Is he going to record 10% or is he going to record 8? He's going to record 8. Because in this particular deal, he's paying 8% interest, so he will record 80,000 in the profit and loss. Now understand one thing very clear. Is Mr. B effectively paying 10%? I would say yes. But is he not smarter than Mr. A? Mr. A is going to charge 1 lakh rupee interest every year in the P&L because that's what he decided as per the deal. Mr. B is going to charge 8%, 80,000 every year. So isn't he a smarter man? He's able to increase his profits at least for the first 2 years to go. Let's say the deal continues for the next 10 years. Is he not able to suppress the interest charge in the P&L over the next 9 years by entering into this deal? You tell the other person that you accommodate my liquidity and the other person agrees, which means you are trying to convince the other person that, okay, I will pay you for the loss, but you accommodate my liquidity. I'm going to pay you lesser interest today, but I'm definitely going to compensate the loss to you at a later stage called a premium. And the other person agrees because he's accommodating your liquidity, but it gives you a good advantage of charging a lesser interest in the P&L. So isn't Mr. B smarter in life? What do you say? So don't you think so that as compared to Mr. A and Mr. B is a more, intelligent man. And that's rightly decided. Because he's been able to manipulate this particular entire things to his advantage. So the premium on redemption is also charged to the P&L to the duration. Yes, so maybe I agree with that, but that premium could always be adjusted against the security premiums as well, without taking a hit to the profit and loss. And then, okay, even if I agree that it's going to hit the P&L at the end, let's say if the loan is for a period of 10 years, at least I'm able to reduce the charge to my P&L over the next 9 years or so. The standard setters exactly understood that what is wrong in accounting. They understood that what is wrong in accounting. And I'll tell you what is wrong. What is wrong in this particular case is A accounts at the rate at which he deals and B accounts at the rate at which he deals. Mind the words carefully. The accounting was giving a lot of advantage to the other person. A was accounting the interest in accordance with what he was paying. B was accounting for the interest in accordance with what he was paying. The deal was structured and the accounting was done according to the way they structured the deal. If I structure the deal this way, I account it at this way. If I structure the deal this way, I account the deal this way. And that would lead to people manipulating deals, lowering the interest rates in the initial years and then compensating the other party later, which means you're able to reduce the burden of interest on the P&L. So the standard setters understood that this is what the mistake in accounting is. That people are charging interest in accordance with the deal they structure. You structure it the better way, you get the advantage of accounting. So they said, no. We will not tell people to charge interest in accordance with what you pay. We will tell them that charge the interest in accordance with substance over the legal form. So they said that this is a defective game. So what you need to see that you should look into the substance of the transaction over the legal form of the transaction. Don't look at the substance of the transaction, but look at the legal form of the substance of the transaction and not the legal form. So in both the deals, A is paying 10% effectively and B is paying 10% effectively because the premium which he is paying is to compensate the 2% loss. So in effect, he's also paying interest at the rate of 10%. Tell him, you pay 8, that's your problem, but you're going to charge interest at the rate of 10% only. If you tell him to charge 10% interest, he also charges 1 lakh. He also charges 1 lakh. At the end of the day, both the people charge 1 lakh. So they said, we can't stop people from making the deals the way they want. You can't stop people. If two people are razi, then you can't make them understand. Mia bibi raji, to kya karega kaji? That's what the saying is. So if the lender and the borrower, both are agreeable to a particular deal, in that case, I can't tell them that you can't deal it this way, but I'll say, okay, you deal the way you want. And I'm going to get the essence of the deal. I'm going to get the substance of legal form and then decide the accounting. And this substance of a legal form gave rise to the concept of what we call today as effective interest rate. This is called EIR. It is called an effective interest rate. So what we'll do, we will say, okay, let's do one thing. Whatever deal you have made, let's put the deal in inflow-outflow terms. Whatever way you want to structure the deal, you do that. We'll go to pen down the entire deal in the inflow-outflow, and we're going to get the effective interest rate, which in finance is called internal rate of return. What do you call internal rate of return? What you call internal rate of return in finance is what we call EIR in financial reporting. So what I'm going to do, I'm going to put your entire deals in terms of inflows, outflows, and get what is the internal rate of return of the deal. So what you're paying is the effective rate, which is IRR. Did you get the concept? I'm going to go more deeper. Did you get this concept? Because I'm going to go more deeper. I'm going to reconcile every data with figures today. But did you get the larger concept that this deal, you need to identify the substance, which is the effective interest rate hidden in the deal? Okay. So that's, I think, great. So wonderful indeed. So I think let's go further now. Let me just share that illustration back to you and let's start working on this. Now I'm going to say a few things on this illustration. Look at the facts of the case and let me say something, start saying something. Let me first tell you that there are no free lunches in life. Let me tell you that there are no free lunches in life. Nobody does a favor to the other person. There is always a hidden agenda. Now, see what it says. On January 1, Tokyo bought 1 lakh bond for 95,000. Let's appreciate one thing. Today, if you buy a bond with a face value 1 lakh and you buy it at 95,000, the other person is going to redeem you 1 lakh rupees at the end of the life. So is he not done you a favor by giving you a discount at the inception? So my thoughts are working. If the other person gave you a discount at time 0, he will never pay you interest at market terms. He will lower the interest rate to be given to you. Do you agree with the statement? If the other person says that I give you a bond which has got a face value 1 lakh and I am going to give you a discount of 5,000, which means he's already done a favor to you at time 0. If he's done a favor to you at time 0, I think you'll definitely agree with me that he's never going to pay me interest at market rate. So he will say, sir, I'll give you a lesser rate of interest. Because indirectly, I've done the favor number 1, the discount, which is indirectly giving you a interest day 1. Then he says in the further sentence, the bonds will be redeemed at a premium of 5960 over and above the face value. Can I say, why would the other person pay me a premium? If the other person is paying me a premium, that means in this particular case, he is again not going to pay me the market rate of interest by giving me a discount at the inception. By giving me a premium on redemption, he is trying to compensate the lower interest rate in the deal, which is that 5%. Am I making sense, friends, on that? Look at the deal and tell me, is this making good sense to you? That in this particular case, when you tell the other person that I will give you a discount, why would I give a discount? If I'm giving him a benefit of discount, I'll never pay him the interest at market terms, I'll pay him less. If I'm going to pay him a premium on redemption, I'll never pay him the interest at market terms, I'm going to pay him less. So by giving a discount on issue, by giving a premium on redemption, it means that the interest rate given, that 5% contracted, is definitely structured below as compared to the market rate. And then as an investor, as per the deal, I've also spent 2,000 issue cost. If I spend 2,000 issue cost, I'll tell him, boss, by making this investment in your company, I had to spend 2,000 rupees. Please compensate me for that as well. So let me make a very strong statement, friends, at this stage, which I will repeat later today. If I see there is a discount on the issue, if I see a premium on redemption, if I see an issue cost, let's call it as a TC, I'm very clear that the contracted rate is much different as compared to the effective rate. The effective rate which you're earning is much different as compared to the contracted rate. That 5% is the contracted rate, but there is much more than what you're earning. The discount means that you're earning effectively more. The premium means that you're earning effectively more. Is my thoughts absolutely correct? Get this very straight. You need to be very crystal clear on the thoughts, how people are thinking in the world. Because, I remember in school, when we were used to be taught these things, discount on issue, premium and redemption, we were given to understand that, we are trying to structure a deal because the other person says that your debentures are not that great, your debentures are too great, and I'm going to pay a premium. There's nothing greatness about it. It's all about that, I'm going to pay interest according to my credit risk profile. But if you're going to ask me favors in terms of discounts and premiums, I will not give you the same rate of interest which I would have given had there been no premium or discount. Do I stand absolutely clear on my thoughts? Correct? I know what I'm speaking is quite technical indeed, but you need to be very, very clear on my thoughts. Wonderful indeed. So yes, sir, there is a discount on issue, premium and redemption, and the interest rate, market rates is not going to be same. That's right. Absolutely true. Wonderful indeed. Great. Now let's do one thing. So if I take the same example, pen it down out here. So in this particular case, what I am going to do now, I'll take the same example. To illustrate the concept of amortized cost or the concept of EIR, we said that the bond has got a face value. The bond has got a face value to the extent of 1 lakh, and it is issued at a discount. It is issued at a discount, and that is issued at 95,000. That is one. And there will be a redemption at premium. There will be a redemption at a premium, and I'm taking the same deal. The redemption will be done at 5960. And there is also a transaction cost, let's call it as a TC, that's to the extent of 2000. The coupon rate decided, the coupon rate which is decided on the deal is supposed to be 5%, and the tenure is supposed to be 3 years. This is the basic deal which I've given you. There is a discount on issue, there is a premium on redemption, there is a TC, and there is a face value coupon rate. So I think that's what the deal is. Now let's start working on this. Yes, that is correct. So in this particular case now, let me now come to the input. So what I am now interested in, I will convert this deal in terms of cash outflow and in terms of cash inflow. We're going to structure this entire deal in terms of inflow outflow. I'll tell them, okay, you made a deal like this, it's okay. But if the other person says my interest income is 5% every year, no, sir. The other person says I'm paying interest 5% to be put in the P&L every year, no, sir. So I'll say, let me find it out. So I am interested in finding out the internal rate of return, that is the effective interest rate in the deal. So look at the deal from the investor's point of view. Look at the deal from the investor's point of view. So he made an investment of 95 and he paid an issue cost of 2. So at 0 point of time, this is coming to 97,000. And if you look at the deal for the next 3 years, can I say in the next 3 years, I'm going to get a coupon rate of 5% on the face value. On 1 lakh rupees, I'm going to get a 5% interest. So I'm going to get 5,000 every year. And then at the end of third year, I will get the face value of 1 lakh with a premium, that is 105,960. And trust me, the question already tells you the EIR is 8%. That is the IRR. Let's check it out. Since we know it is 8%, let's see that what is the NPV at 8%. Let's see the calculations and see what is the NPV at the rate of 8% in this case. So we can say 5,000 is the annuity for the next 3 years. Let's see at 8% discounting factor, 1, 2, 3. This is 2.5771. And we're going to get this 105,960 at the end of third year. So at 8%, this comes to 0.7938. So this is the inflow minus the outflow is 97,000. Let us see what is the NPV. If it is 0, that means what? That this is the internal rate of return. So 105,960 into 0.7938, 84,111. This is 84,111. And this is coming to, I think, approximately 0. It's coming a difference of around 3 rupees or something. So this is coming to effectively 0. This means the internal rate of return of the deal is 8%. So I'm going to tell the person that you're paying effectively 8. To the issuer, you charge 8. You are getting effectively 8. You take an income of 8. So we say that your accounting is not going to be done at this coupon rate. Your effective rate of return is 8%. You will record your finance income. I'll tell the holder, you will record your finance income at 8% and you're going to record your finance charge at 8% of the issuer. So let them structure the deal the way they want, but the interest is going to be captured looking at the effective interest rate in the deal, which is the IRR. Let's do one thing, friends. Let's make a ledger account for a better understanding and let's do some recall. Let's do some reconciliation as well to get a better understanding. The next 10 minutes is going to give you a team level of clarities in life. Let's, I think, go ahead. I want to now look at this entire deal in the form of a ledger account from the holder's perspective. This time, I want to make a financial asset account looking at things from the holder's perspective. Let's see how the accounting is going to take place. So let's have a look at the entire accounting of this financial asset in the books of accounts. So in the inception, he made the investment that is 97,000. And I'm going to record the finance income. So are you going to record the finance income at 5%? No. Are you going to record the finance income and accrue it at the rate of 8%? Yes. So I'm going to take the finance income at the rate of 8% on this. So on 97,000, 8% works out at 7,760. Is this what will be taken in the P&L? Of course, yes. I don't care what you're getting. I need to consider what you're effectively earning every year. This is what you're earning effectively. What you agreed to take from the other person is, he said, I'll give you 5%. That's what you got. But you're effectively earning this much. So this is what is going to be entered in the profit and loss of the company, not this 5. Not this 5. Your finance income is what you're effectively earning on the deal. Let's look at the balance sheet balancing figure. And let's make this for 3 years. So let's get the balance sheet balancing figure. This becomes the balance BD next year. So I think this is going to be 99,760. This is going to be 99,760. Again, I'll take the finance income at the rate of 8% on this particular deal. So let's take 8% on 99,760. That works out at 7,981. Again, I'm going to receive 5,000. That is the coupon rate. And we get the balance CD balancing figure. You can see it's a mirror accounting as compared to the financial liability component of CFI. In terms of CFI, what you were doing, we're exactly doing the same mirror accounting in this case. The debits have become credits and vice versa. So if I take this total, this is coming to 102,741. This becomes the opening balance next year, 102,741. Again, let's take the finance income. Let's take it as a balancing figure in the last year, just to, tally the accounts. So I'm going to consider the figure of bank. So you get that 5,000 coupon and you're going to get the premium over and above the face value, 105,960. So if I take the difference is 8219 and this should approximately be equal to, I think, 8%. Let's see if this is coming approximately 8%. Yes, it is. Now let's see some more clarity of thoughts in this particular case. So I think we can see very clearly that this is the finance income which is taken in the P&L. Now let me ask you a basic accounting question. At the end of the day, do you think the credits in the P&L and the debits in the bank should match? If you record an income in the books of accounts, in the profit and loss, do you think the credits in the P&L over a period of time and the debits in the banks over a period of time should ultimately match? If you say it's an income, the credit in the P&L and the debits in the bank should 100% match, correct? Because if you're doing double entry bookkeeping, you may record things on accrual basis, but then you're going to ultimately receive the money as well. So what you credit in the P&L is ultimately going to come in the bank account debit as well. Agreed with me, I guess. So that's rightly said. Yes, sir. There is one. Okay, I think that was the previous one message. And I think I got the inputs. Double entry, it should definitely match. That is absolutely correct. Makes common sense. So issue cost based by the issuer, not for the holder. No. The issue expense which I've given you is the transaction cost incurred with the holder. I invested the money. I had to pay some brokerage to the broker. So that's my issue expense. So that transaction cost is, use the word issue expense, but it's not issue expense for me. It's like, money paying to the broker. That's my TC, transaction cost. So this is being paid by the holder itself. Okay, so now let's come to the reconciliation statement. So as we said, the credits in the P&L and the debits in the bank. So I want to make a reco statement. I want to make a reconciliation statement that what is the credit in the P&L and what is the debit in the bank. What is the debits in the bank? Is that matching or not? Now let's look at the deal. How much are you crediting in the P&L? The credit to the P&L is over a period of 3 years. So we can see the credit in the P&L in the first year is 7,760. The credit is 7,981. And the credit in the P&L is 8,219. So we can see this is the credit in the P&L over the period of 3 years. Now let's see the benefits. At 0 point of time, I got a discount 5,000, but I had to incur 2,000 issue expense. So my benefit indirectly gets reduced because 5,000 is the discount and 2,000 is the issue. Then in the first, second, third year, I got a coupon rate of 5,000 every year. I got a coupon rate of interest 5,000 every year. And I also got a premium at the end, which is 5,960. So let's see, is the total of these two columns matching or not? So 7,760, 7,981, 8,219. This is coming to 23,960. And that is 3 plus another 15 plus 5,960. Wow, this is coming to 23,960. And this gets matched. So which means that this is the way they've structured the deal. This is the way they've structured the deal. So I can't tell them to give a credit in the P&L according to this. You structure the way you want. So the accounting doesn't get governed by your contract. You can see that the entire concept in terms of Indian accounting standard is beautifully, summarizes that your contract is not the way I account. If you write something in the contract, I don't accept it. I don't account the way your terms and conditions are dictated in the contract. I get the essence of the contract and I see that what is in substance of legal form. When I start looking at the substance of the legal form, you structure the deal that, okay, give me some benefits today, give me some benefits later. You're staggering the benefits. You're staggering the benefits. If you're staggering the benefit, that does not mean that I'll credit the P&L in accordance with what you're paying. So this is the credit to the P&L. Does this mean that 8% represents the fact, had there been no premium on the deal, had there been no discount on the deal, had there been no TC, can I say the interest rate, coupon rate would have been 8%? Yes. The journey of that 5 to 8% movement is on account of these three factors: the premium, the discount, and the transaction cost. Had there been no premium, no discounts, and no transaction cost, trust me, the coupon rate would have been 8%. The other person would have said, I want 8%. He agreed to take a less than 8% because he said, I give you discount today. Okay, sir, reduce it. I'm going to give you a premium at a later stage. Okay, sir, reduce it. But I said, sir, please increase it slightly because I've incurred a TC as well. And that makes it a complete reconciliation. I hope, friends, I stand absolutely clear on my thoughts. This entire concept is called the amortized cost approach of using the concept of effective interest rate, that is called EIR. It's applicable in terms of Ind AS 23 as well. It's applicable in terms of Ind AS 109 as well. Because even in terms of Ind AS 23 borrowing cost, the interest which you capture is supposed to be the interest rate computed as per 109, which is called the effective interest rate. This is what is called EIR, the effective interest rate, which is hidden in the deal. IRR for finance, EIR for financial reporting is same. Right, friends, I hope I am perfectly clear on my thoughts to you. You've understood the essence. That's right. Wonderful indeed. Perfect. So this takes care of the agenda. Now let me just come back on this. This was one thing which I wanted to illustrate, the concept of amortized cost. This is, you can say, using EIR, that is called effective interest rate. This is called EIR, that is called using the effective interest rate. So we want to see that what is the effective interest rate, which is the internal rate of return. That is one base. We are working towards the chart which I showed you a couple of minutes back. The idea is to understand that chart. So let me just come back on the agenda, and we're going to go step by step everything. We're going to develop things wonderfully, step by step by step. The only thing which I want is cumulative revision, friends. Now, since we have turned to the holder, now even if you don't revise the earlier portion, it's fine with me. But now from this session, you need a cumulative revision of the session 4, 5, and so on. So coming back to the agenda, the initial recognition is at a fair value, and the subsequent recognition is based on a three-step model. And based on the three-step model, in this case, we have understood what is amortized cost. There is no fair value accounting. There is no fair value accounting. It is accounting on the basis of the effective rate in the deal. And then comes FPTPL and FPT-OCI. Okay, so I guess, friends, I think we talked about the OCI the other day. I don't know. I think I asked you about OCI. I think I gave you some essence on OCI. Did I? I don't remember. So can I comfortably go with the idea that you know about the SOCI I gave you, but I don't know if I gave you anything about the other comprehensive income. I gave you SOCI, but I don't know, not other comprehensive income. So what do I presume that you know about OCI? or do I need to give you some inputs about OCI as well? Building your concepts on the concept of other comprehensive income as well. I've got a constructive obligation to do so, though you're done with Ind AS 1. So yes, sir, your constructive obligation seems to be quite endless. So you want me to give you insights on the other comprehensive income as well? So we don't know about other comprehensive income. Okay, that was done, I think, in Ind AS 1. Anyway, I think let's give you another conceptual understanding at this stage. Let's give you another conceptual understanding because this is important to understand the logics as well. So what I'm going to do, friends, I am just, going out of this particular topic more or less and giving you the concept of an other comprehensive income, which you must understand in detail. Because this standard financial instrument is going to give you a very good comfort zone in terms of reading OCI and in terms of reading the concept of SOCI. You're going to get a complete build in terms of looking at practical financial statements and understanding them carefully. Okay, let's, I think, begin. So I am now giving you another concept, and I am giving you the concept of other comprehensive income. So just to connect the dots, I'm going to give you OCI. Then I'll come back. I'm still working on my larger chart. By the end, but in the next class, of course, we'll be able to get the complete hang on that chart. Okay, let's now look at the concept of OCI. Let's take a simple example to understand. So let's take a very simple example on a timeline. This is 0 point of time. This is first year. This is second year. And let's say this is third year. So I am going to consider an investment. An investment, of course, is a financial asset. I'm going to consider investment, and that investment, of course, is a financial asset. Now, what's this? So let's say a company purchased an investment, let's say at 6 lakh rupees. And let's say the fair value at the end of first year is 9 lakh. Let's say the fair value at the second year end is 11 lakhs. And before the third year, let's say this investment is sold. Let's say this investment is sold, let's say to the tune of, let's say 12 lakh. So I'm taking a very simple example that this is the value at which investment was bought. This is the cost also, and this is the fair value also. And this is the fair value at the end of first year, second year, and then before the third year, it is sold. Now, watch this carefully. What am I going to do? Now, let me see the extracts. Let me take you to the extracts of the balance sheet. And let me also make the extracts of the income statement for a period of 3 years. And let me also make my statement of changes in equity. Let me also make an extract SOCI. So we're going to look at the extract balance sheet, extract income statement, and the extract SOCI as well. So in this particular case, let's say this is the balance sheet extract, year 1, 2, 3. And let's consider we are taking the investments in the balance sheet. That is on the asset side. And I'm also considering equity side. I'm considering other equity. And if you remember, the other equity is elaborated by SOCI. I think that you recall. So this is statement of changes in equity. So this is tab 1, this is tab 2, and this is tab 3. This is tab 1, this is tab 2, and tab 3. Now, in this particular case, let's say this is the income statement. And this is, let's say, year 1, year 2, year 3. For the time being, let me tell you one thing. That what goes in OCI, I'll disclaim what I'm saying. in the next session. But for the time being, just consider unrealized gains are taken in OCI. For the time being, just consider unrealized gains are taken in OCI, and you can say everything else goes in P&L. If there is an unrealized loss, P&L. If there is realized gain loss, P&L. So for the time being, I am going to consider that I'll capture the unrealized gains in OCI. Rest everything I'll put in the P&L. Let's go with that facts for the time being. Let's begin. So I want you to give me the insights. So you're going to show this investments on the balance sheet date at a fair value. So can I say this investment will be shown in the balance sheet at 9 lakhs. Your investments are captured, let's say, at a fair value at the end of the year. So tell me, is this gain realized or unrealized? Their investment was 6 lakh rupees and the investment is recorded at a book at a value of 9 lakhs. So this 3 lakh is realized, unrealized? Of course, unrealized. I did not sell the investment. So it is supposed to be unrealized in nature. So we put that 3 lakhs. There is P&L and there is OCI. We put this 3 lakh in the OCI. Now let's appreciate why. So you said unrealized gains are taken in OCI. You said that. Now please hear me carefully. Please watch the two chains I'm giving you carefully. I'll document that as well, but please watch the two chains carefully. When you put something in the P&L, it impacts the profits of the company. P&L plus OCI is the total income. When you put something in the P&L, the profits are impacted. The EPS is impacted. When you put something in the P&L, the profits are impacted, the EPS is impacted, and it goes in tab 2. It's available for dividend distributions as well. So there are 3 important aspects which you need to keep in mind. You put anything in the P&L, the profits change. You put anything in the P&L, the EPS changes. And it goes in the tab number 2, is available for dividend distributions. Am I clear? Am I absolutely clear on my 3 parts? I'll document that as well. No worry, but just keep this very, very clear in your mind. That when I am looking at the accounting, in this particular case, we are saying you put something into the P&L, the profits change, the earning per share changes, and you can say it goes in tab number 2, available for dividend distributions. Next, when you put something in the OCI, the profits of that year changes because OCI is a part of the total comprehensive income. But the EPS does not change. Because what goes in the other comprehensive income does not change the earning per share. EPS does not take OCI into account. And number 3, it goes in the tab number 3 and is not available for dividend distributions. So you need to understand the chain of P&L and the OCI. When you put in the P&L, the profits get affected. The EPS gets affected. It goes in the tab number 2, available for dividends. Where it goes in the OCI, the profits are affected. The EPS is not affected. It goes in the tab 3, not available for dividends. I hope my thoughts are very clear. So the standard setters are a very brilliant approach in terms of segregating the P&L OCI, because when you put things in the P&L, they go to the tab 2, it gets available for dividend. When you put something in the OCI, it goes in tab 3 and is not available for dividends until it gets realized. Until it gets realized in this particular case. So let's, I think, work upon this. So now you need to get the connect very clear. What is the role of P&L and what is the role of OCI in this connect? Now, let's come back. So this 3 lakh rupees taken in the OCI is going to go to the tab number 3, and the sum total of all these tabs, is going to be other equity in the balance sheet. The sum total of all these 3 tabs is going to be other equity in the balance sheet of the company. Wow. Now let's go ahead and look at the next year. Now the investment from 9 is come to 11 lakh rupees. So can I say there is a gain to the extent of 2 lakh rupees? And is this gain realized or unrealized in nature? Again, it is unrealized in nature. Again, it is unrealized in nature. So we're going to put that 2 lakh rupees in the other comprehensive income. And this 2 lakh rupees is taken in out here. This 2 lakh rupees is taken out here. So this 3 plus 2, now the cumulative total becomes 5 lakh. The cumulative total becomes 5 lakh, and this is 11 lakhs and this is 5 lakhs. And you know that this 5 lakh is standing in tab 3. It's not available to pay the dividends. So far, so good. I hope you're able to connect the dots in this case. So every time you capture the fair value, I'm putting the fair value changes in the OCI, unrealized gains. So I said that I'm going to capture the unrealized gains in the other comprehensive income so that the earning per share is unaffected, so that the unrealized gains do not become available for dividend distributions as well. Right? Now let's go further. Finally, you sold the investment at 12. Is that gain realized or is that gain unrealized in nature? You sold the investment. So now 11 lakhs of investment sold at 12 lakh rupee. That's a realized gain and P&L or other comprehensive income. If this gain gets realized in nature, so where are you going to park this gain? It's realized in the profit and loss account. So once I put that 1 lakh rupees in the profit and loss account, it goes in the tab number 2. It goes in the tab number 2. So far the journey has been simple and straight. Now the question what comes to the mind is this 5 lakh rupees also got realized? You put that 5 lakh rupees which was unrealized till the investment was not sold. But today when you sell the investment, isn't the difference between 6 and 12, the entire 6 lakh gets realized in nature? Yes. If that 6 lakh gets realized, that means this 5 lakhs in tab 3 is also realized in nature. So if it is realized, now it should be available to pay the dividends. So what we are going to do in this particular case, we reduce the 5 lakhs from here and we add this 5 lakhs to the retained earning column, making this available to pay dividends. Making this available to pay the dividends in this case. Now friends, the next few minutes, very, very crucial indeed. The next few minutes are very crucial indeed. So watch me very carefully on this. In terms of other comprehensive income, there are basically two parts. One is called OCI with no reclassification. And one is OCI with a reclassification. If you say that there is no reclassification, this is a case of no reclassification. It gets shifted from tab 3 to the tab 2. It gets shifted from the tab 3 to the tab number 2. It is called no reclassification. But if you say that this is a reclassification, I will add this 5 lakhs to the profit and loss account if it is a case of reclassification. Now, the standard setters have decided in which case it is R and in which case it is NR. So the standard setters have decided that, okay, in this case, it is with a reclassification, and in this case, it is without a reclassification. If you remember looking at the chart, it was very clearly given in the chart that this is a fair value through OCI with no reclassification, with reclassification. And there is a logic to that as well. There is a logic to that as well. Imagine when you put this 5 lakhs into the P&L, will the EPS of the third year get affected? Tell me. This 5 lakh is nothing but the total of this 3 plus 2. This 3 lakh did not affect the EPS of year 1. This 2 lakh did not affect the EPS of year 2. But when you put that 5 lakhs in the third year P&L, can I say now it is affecting the P&L, the EPS of third year? So till it was unrealized in nature, it was not affecting the EPS. When it got realized in nature, it is changing the EPS as well. And if it is a case of no reclassification, it is a direct shifting of 3 to the tab number 2, and in which case the EPS does not get affected. So this is getting over my nerves. So don't worry, we'll be making some inputs on this in the next session as well. Because I know this is not a very easy stuff. But I think what you need to get the connect right now, let me just connect the dots once again to get the connects absolutely fine. So for the time being, certain things which you need to keep in mind, which has got exceptions, but certain things in mind. Number one, unrealized gains are captured in the OCI. That's one. Don't worry, I'll document that. This is for the time being. Unrealized gains will be captured in the OCI. That's one. So when you take this in the OCI, it goes in tab 3. And that's not available to pay the dividends. But the day when the investment is sold, if it is a case of no reclassification, it is shifted from tab 3 to tab 2 because it is available to pay the dividends now. And when it is a case of reclassification, it is put into the P&L account. Now, friends, hear me carefully, then I'm start going to documenting this. Now, please hear me carefully. I am now saying things about P&L and about OCI, R and NR. Watch this and then I'll document. When you put something into the P&L, 3 focus points. Does the profit get impacted? Yes. Does the EPS get impacted? Yes. It goes in the tab number 2, available for dividend distribution. Yes, correct. Second, when you put it in the OCI NR, is the profit impacted? Yes. Is the EPS impacted? Never. When it is put in OCI, it does not impact the EPS. When it shifts from 3 to 2, it also does not impact the EPS. What goes in OCI NR never ever affects the earning per share. Never ever affects the earning per share. When it was unrealized, not even then. When it got realized, not even then. And it goes in the tab number 3, which is not available to pay dividends, but when it gets realized, it is shifted from 3 to tab number 2, so that it becomes available. Number 3, I'm looking at OCIR. Does it impact the profits of the company? Yes, it does. Does it impact the EPS of the company when it is unrealized? No. Does it impact the EPS when it gets realized? Yes, because the accumulated balance is taken in the P&L and the EPS get affected at that stage. So it does not impact the EPS when it is unrealized, but it impacts the EPS when it gets realized. And then once the investment is sold, then the amount in the tab 3 is reclassified in the P&L. It's not directly shifted in the tab number 2, but it is transferred in the profit and loss account. Are you able to connect the dots at this stage? Okay, I think I'm getting some inputs on this. So in effect, they're taking the amount to the P&L in the end of the year when no reclassification ultimately goes to tab 2 and is available for dividend. Absolutely correct. That's absolutely correct in this case. So why is the gain does not go to the OCI? Because of realized. I mean, that's 1 lakh. You see, when you sold the investment, it's a realized gain, and that realized gain is going to the P&L. As of today, we're going to put the unrealized gains in the OCI and the realized gains in the P&L. Next class, I'm going to make some exceptions to the model, where I'm going to give you exceptions of all the inputs which I've given you so far. This only works as of today. I'm going to make changes on that. Okay, I think let me just pen this down as well now. I think it's a good need to pen this down as well. Don't worry, we'll, I think, connect these dots more in the next session with you. But as of now, what we have understood, so I'm just penning down my thoughts in this case. So my thoughts goes like this. I'm looking at the 3 inputs I've discussed. I'm looking at the 3 inputs. When you put something in the P&L, when you take anything to the OCI NR, and when you take anything in the OCI R, what are the implications on the profits, EPS, and it goes in SOKI tab numbers, etc. So the first thing is that I'm looking at impact on profit. Now, one thing you need to understand very carefully, that whether you put anything in the P&L or you put anything in the OCI, it is a part of the total comprehensive income. Because when you take the profits for the year, it's a sum total of the P&L and the other comprehensive income. So is there impact on the profits? Yes. Is there impact on the profits? Yes. Is there impact on the profits? The answer is a big yes in all these cases. The next is we're looking at the impact on the earning per share. So when you put something in the P&L, does it impact the EPS? Of course, yes. But when you put something in the OCI, it does not impact the EPS at that stage because it is NR. It will shift from tab 3 to 2. So never ever EPS gets impacted. EPS is never impacted. In this case, the EPS is never impacted, whether it is realized or it is unrealized. The EPS never ever gets impacted. And in this case, we can say the EPS gets impacted later, not at this stage. It gets impacted later because the money in tab 3 is taken to the P&L. Whatever is accumulated in the tab 3 is reclassified in the P&L, so the EPS gets affected later. So this affects the EPS now. This doesn't affect the EPS ever, and this affects the EPS not now, but at a later stage when it gets realized. And finally, what you need to keep in mind is that it goes in statement of changes in equity in which tab number? This goes in the tab number 1 as a part of the retained earnings. This goes in the tab number 3. This goes in the tab number 3. They both go in the tab number 3. Now, in this particular case, when this goes in tab 3, since it is NR, you can say when it is realized. In this case, when it is realized, what happens? It shifts from tab number 3 and it goes to tab number 2. When it is realized, we shift that money from tab 3 to the tab 2. And in this case, when it is realized, in this particular case, what do? We put this money in the profit and loss. It goes from the tab 3 to the profit and loss, and therefore the earning per share gets impacted at a later stage. So this was quite heavy indeed, I know. So you want me to give you some connects in the next class, consolidating this picture at the very start, of course. You can say yes, I'll do that for you, so that you get more connected in terms of the concept of OCI, NR. The implications need to be brilliantly clear. Yes, I think somebody's got a question. Yes, Peter, please go ahead.
Sir, on the profit and loss account, the first thing on that SOGI, tab number 2, I think it's not 1, I believe.
Oh, sorry, my mistake. It's tab number 2. That's right. Thank you.
Thank you, sir.
So I hope you got the dots basic connected, but I would definitely, add on to these discussions in the next one as well. In the next session, that is what I'm going to do. I'm connect you a little more because I want, before I work upon the chart which I showed you, we need to be crystal clear on all the permutations and combinations in this part. All right, friends, must have been a heavy day indeed. Some levels again going up. Yes, interesting, but it's getting interesting. Okay, so I think that's all seems to be good for the day, friends. Any questions on your side? Otherwise, I think we're done for the day. We're going to do some very interesting agenda discussions in the next class on Saturday.
Yes, sir. Your teaching style is totally different and it's lovely. You are taking care of each and every step. And
Thank you so
it's
much.
Amazing, sir. It's wonderful.
Thank you very much. That makes my day. Thank you so much for the kind words.
Yes, sir. I'm thank you from my bottom of the heart. You should live long.
Thank you so much. Living healthy is more important than living long. Right, friends. I think, thank you for the wonderful teaching. Thank you very much indeed. Thank you so much for the wonderful class. Thank you very much indeed, friends. So time to say goodbye to you, friends. See you in the next class. Thank you. Bye-bye. Take care.